bond buying program begins.
Hello, it's Adil bringing you a review of the US markets starting the Monday, the 9th of March 2015. Okay, so bringing you an intermarket analysis perspective. This is obviously Monday morning, currently 10 a.m., so a bit late with regards to my weekend analysis, but I'll go through it now given the fact that the Asian markets have traded overnight. Okay, so the S&P 500 finished obviously a whopping 30 handle low, a sell-off, so down minus 1.4%. on a Friday around the 2070 level. Futures are currently trading on that same region again. Okay, the Dow was absolutely obliterated down, I think almost in excess, or was it almost near or in excess, I can't remember now, of around 300 points. Almost, well, now minus 280 points, so down quite substantially. The Nasdaq was hit as well. My Russell chart, my SMH, Dow Transports obviously are under the cosh. Okay, so basically overall a risk-off scenario there. Okay, overnight though, Shanghai has managed to reverse its gains. Okay, so up quite substantially. Obviously interpreting the Chinese data over the weekend as being bullish. You had stronger exports. Obviously the balance of payments basically 10 times greater than expected. Okay, so pretty impressive there, although a lot of individuals are stating that the data is skewed somewhat given the Chinese New Year. Although it is what it is, folks, you have to respect the data. Although imports obviously declined, that's why Europe is certainly under some pressure. But I think QE, for my interpretation, basically is QE trumps any fundamental concerns, as we all know, because everybody loves a Kool-Aid. And happy QE day. I think that's what I should name this video, Happy QE Day, because the QE in Europe starts today, and the central bank put is alive and kicking. Anybody who attempts to trade against central banks, as we all know, gets pulverized. Okay, so always bear that in mind if you are attempting to obviously embrace some type of bearish bias on US indices. From my perspective, QE trumps that. Okay, that's European. That's a European slant. So if I'm looking at it from an intermarket analysis perspective, my understanding is that Europe. My understanding is that Europe. Okay, I will go. I'm working. Go. Okay, so that's my little daughter telling me to close the window because it's raining outside, advising me now. Okay, so basically we have the economic data from the US. Okay, so bear in mind from an intermarket analysis perspective, the European QE put is active in the background. Therefore, that will lift European markets higher, which will lift or prevent any major sell-off in Europe, which obviously will negate the sell-off from the US, and obviously that will restore balance from a global market perspective, i.e. US markets higher, short squeezing higher. Okay, now the other angle that I'm going to look at obviously is from the US jobs perspective. Now the US jobs obviously was stellar, came in quite substantial. That's good. Okay, we all know that's good. Okay, but that hasn't moved the Fed, and the Fed is focused on core inflation or real wage inflation, and basically that wasn't impressive at all. Average hourly earnings or wage growth, as we all like to know, wasn't impressive. That will not force the Fed to move. And the other factor as well that a lot of individuals are forgetting is the fact that tapering has already, I mean, I won't say tapering, but interest rates rise has already begun to a large extent, because the US dollar, I mean, look at the chart of the US dollar, up quite substantially. Now, do you think that the Fed would jeopardize the recovery and growth in the US, given the fact that the dollar obviously would appreciate quite significantly? Okay, and given the fact that the ECB is already doing QE, therefore the dollar is going to go higher regardless. Okay, so in essence, an interest rate rise equals ECB QE, i.e. a firmer and stronger dollar. So if the US were to raise rates now, that would obviously hamper and impede growth even further. Okay, so I can't see them doing it from that perspective. And also they need to have justification, i.e. real wages, and real wage growth was not there on Friday's job data. Okay, and that's the barometer that will make them move. And if that barometer is not there, then I think from my perspective and my understanding is that they are not going to raise rates. Markets are obviously trying to read too much into the data, and that will not force the Fed. And don't be surprised if you have several Fed officials come out today and start talking the dollar down. Okay, from my perspective, I think they have to talk the dollar down quite substantially. The data will do that for them anyway, from my perspective. Okay, and before they attempt to raise rates. So expect quite a substantial dip in the dollar or fall in the dollar before you actually get an interest rate rise, because the dollar itself is already forecasting an interest rate rise now already, and it's already impeding and hampering, obviously impeding growth, and from that perspective it's going to be very hard for them to justify a rate rise, i.e. real wages. Okay, and given the fact that QE is already doing its job to raise and force the dollar higher, and given the fact that every other central bank around the globe is trying to debauch its currency or talk its currency down, that in itself is actually doing the Fed's job of raising rates, or raising rate expectations basically. And again, even if you were to raise rates at this very juncture, do you think the market has already would you not think the market has already factored that in as well to a large extent? So that's certainly a factor, that's certainly a different angle that we can look at. But my main understanding is that real wage growth was not there on Friday's jobs data, therefore no rate rise, regardless of how many jobs they create, okay, because the yardstick is going to be real wages. Okay, so if that was the case, and the whole pretext and the premise that the market sold off on Friday was based on the fear or expectations of a rate rise, in obviously being pushed forward to June and September, potentially 2 rate rises, then again, and obviously fear of the Fed falling behind the curve, etc., etc. So it's just, from my perspective, that's what I'm reading into it anyway. Okay, everybody has their own mindset and understanding, but that's my understanding. Therefore, that's going to force me to remain positive on US indices. And obviously, given the fact that it's QE happy day, or happy QE day in Germany, I mean, I'm reading a tweet now, ECB confirms QE has started, Bundesbank says was active in the market. Okay, so the QE put is alive and active in Europe, and that should propel all global markets higher. Okay, righty then, so let's look at the actual technical landscape now, and let's see where the US market is from a technical perspective. Okay, start with the Nasdaq 100. Looking at a daily chart first of all. Daily chart, provided it remains above this previous resistance equal support above 43.50, we remain bullish. Daily chart is just a small contraction or a pullback. Okay, 60-minute chart, we have a HNS formation. Now the Apple Watch is going to be announced today, and obviously they've got the curtain style promotion. So curtain raiser promotion. So I think the Apple Watch will certainly act as a put. Okay, just like a central bank acts like a put. So you have the Apple Watch put, you have the central bank, i.e. ECB QE, Kool-Aid put. So those two puts will be active, and they'll keep the markets alive. Okay, and especially with regards to the Nasdaq, it's very hard for a HNS to actually hit its target if you have the Apple Watch in the background. Okay, so again, that will certainly create a catalyst for a short squeeze, and certainly looking to propel higher. I mean, we may well test the neckline again at 44.30, or potentially even break the HNS, but I expect the HNS to be broken. Okay, right, 10-minute chart of the Nasdaq. Okay, is obviously we are in this bearish channel. I expect this channel to be broken and potentially test the 44.20 and the 44.35, and don't be surprised if you hit the 44.45 level, which is the 200 MA. The next level of resistance then would be 44.60, and then obviously 44.80, sorry, which is gap fill. Okay, and that's basically where we are. We had a thrust higher and a higher volume towards the close, which is a bullish sign, and that's basically where we stand. Now the indices that we use to confirm and do some cross market analysis and cross verify the support and resistance is the biotechs. So this is the semiconductors and the biotechs. So semicons, previous resistance equals support, therefore that would there's a strong argument that that's into support, which will obviously help the Nasdaq. Gap fill support on the biotechs, again strong argument, and Nasdaq is going to bounce. Okay, now let's have a look at the Dow. The Dow itself. Okay, so we've had quite a substantial sell-off, breakout of the bullish channel. We are into previous resistance equals support and 50 MA support. We also have your fib retracement. So if you take the fib from pivot high, pivot low to pivot high, and we are looking at a 38% Fibo support. Okay, so basically we are into support. Obviously, if that fails to hold at 50 MA, then the next support level is 17,690, then obviously 200 MA down below. But from my perspective, very hard, given the fact that, like I explained, the QE central bank put is certainly active and everything moves in tandem. 60-minute chart, the HNS formation has been hit. Okay, so from my perspective, you are looking at a short squeeze. We're into the 200 MA and we have horizontal support. So certainly a reversal is on the cards for the Dow. The Dow Transportation Index, this is an interesting one. This has been weak from the outset. If you look at a daily chart of the Dow, you can see it's Dow Transports. We had a lower high. Obviously the market's flushed on a daily perspective. 60-minute chart, we have this HNS formation that certainly needs to be respected. A move lower will put you into support around the 8820 region, so that's something that we'll keep an eye out for, okay, on the 60-minute chart. Okay, the next phase or next chapter we're looking at is the S&P 500 for US markets. The daily chart we look at first of all. We are into the 50 MA, into the fib 38% at 2066, and previous resistance equals support at 2065. So 2065 is a solid support zone. Okay, that is expected to hold. Okay, the 60-minute chart. Let's move on to the 60-minute chart now. HNS formation, we have two. The mini HNS formation obviously hit its target at 2080. We're currently at 2065 now, so quite a substantial sell-off. And then we have the bigger HNS, which is obviously the neckline at 2086, and it's giving you a projected target of 2050. From my perspective, the level at 2065 and 2070 is a solid support zone, which corroborates with the daily chart and the 50 MA and the daily. I find it very hard to see if the market will certainly move lower than that, especially given the fact that the QE put is active in Europe, and like I said, the Apple or the iWatch put is certainly active in the US, and it's given the fact that the Shanghai index, which I explained earlier on, as you all know, the Shanghai is up by 1.88%. Yes, I know the Nikkei is down almost 0.95% because it missed out on its GDP target. I think that still leaves the door open for more QE in Japan. So again, that's, I think from that perspective, it's potentially negative. Okay, in terms of the growth rates, but positive in terms of QE. Okay, because it means it leaves the door open for more QE. Okay, so 10-minute chart of the S&P 500. We're in this bearish channel. We had a thrust higher and good volume. Okay, that generally is an indicator that we are looking at a potential bottom and then a reversal. So you're looking at initial resistance 2082 and then 2087. Obviously, if you push higher than that, 2095, then 200 MA, and obviously resistance above. Okay, and that's basically where we stand from that perspective on the S&P. Next chart we can look at is the Wilshire 5000, and that generally tends to corroborate or confirm the move of strength in the S&P 500 along with the Russell. We're into previous resistance equals support. Any move further below is back into the 50 MA, so again that certainly needs to be respected. Using a Fibonacci retracement from the pivot high low to the pivot high, you are into the fib 38% resistance or support, therefore you are looking for a potential bounce. Okay, 60-minute chart of the Wilshire is obviously, you do have the HNS formation that certainly needs to be respected. You are into 200 MA and previous resistance equals support, and we are looking to potentially bounce given the fact that it's at the lower channel support zone. Okay, so certainly looking to bounce. Again, the HNS on the Wilshire, again, if it tests the neckline, that's going to be important. If you break the neckline, then you know there's a short squeeze that's about to occur for global markets. Okay, so certainly take that into consideration. Again, QE happy day or happy QE day. Remember, the central bank put is very hard if one central bank, which obviously is Europe, and Europe, as we all know, is one of the major exporters for America. If that's doing well in terms of QE and that's raising incomes and standards and increasing the affluence and opulence, again, that's bullish for global markets. Okay, especially with China obviously up by 1.88%, it's very hard for this HNS to play out. Obviously, if we get more hawkish commentary, that will obviously create more fear of a rate rise, and that may well play out, will force this HNS to play out. Again, be flexible and be fluid and allow the markets to dictate. 10-minute chart of the Wilshire 5000 is clearly showing that we are into this lower channel support, basically looking for a thrust higher and again a break of this bearish channel. Okay, Russell, last index I'm going to elaborate upon, the Russell 2000. Yes, we have flushed out this rising contracting wedge pattern, but we are into previous resistance equals support, which again has to be respected. Okay, and that's basically where we are, folks. Okay, so I think I've covered all that, although I do need to highlight the emerging market index as well. We are into potential support on the emerging market index and looking for a potential bounce. So again, that does add to the thesis or argument that we are looking for a potential bounce on the US markets. Again, it's all about the S&P 500 in reality, and the S&P 500 on the daily chart, that solid support level around the 2065 which obviously coincides with the 50 MA and the Fib 38%, and that alone should be enough to keep the US markets above. So 2065 is your do or die zone. If you dip below 2065, that's going to be a major concern, and if that is the case, then we do open up 2020, 2040, even 2000 again, which is problematic. Okay, problematic for the bulls. But again, allow the markets to dictate. I personally find it very hard to envisage us moving lower today, given the fact that I've explained. You've got the European QE put, okay, you've got the iWatch put, and obviously now you've got the Chinese put as well, okay, and it's going to be very hard from that perspective. Okay, folks, so risk on, risk off, wax on, wax off. Goodbye now.